Welcome to Financial Market Insights for Traders. I'm Sophia, your host, and today we're diving into a subject critical for traders navigating today's increasingly complex markets: economic indicators. Whether you're trading stocks, forex, commodities, or cryptocurrencies, understanding these indicators can provide you with the insights needed to anticipate market trends and make informed decisions. Let's begin by unpacking what economic indicators really are. Simply put, economic indicators are data points or statistics that reveal key aspects of a country's economic health. These indicators help traders, investors, analysts, and policymakers interpret economic conditions and forecast future market movements. They're typically categorized into three main groups: leading, lagging, and coincident indicators. Leading indicators, like manufacturing orders or consumer confidence indexes, often signal economic shifts before they fully materialize, making them incredibly useful for traders looking to stay ahead of the curve. Lagging indicators, such as unemployment rates, confirm economic trends after they have already begun, reinforcing or clarifying existing conditions. Coincident indicators move in real time with economic cycles, providing immediate insight into the current economic state. Today, I'm going to guide you through the most crucial economic indicators and how recent events have emphasized their importance for retail traders. First up, gross domestic product, or GDP. GDP represents the total value of all goods and services produced within a country and acts as the broadest indicator of economic health. Recently, we've seen market volatility surrounding GDP reports, notably from the United States and the Eurozone. A growing GDP typically signals a robust economy, boosting stock markets and strengthening the local currency. Conversely, declining GDP figures, as seen recently amid fears of recession across major economies, often indicate weakening currencies and pressure on equity markets. Traders closely watch quarterly GDP data, as deviations from market expectations can create significant trading opportunities. Next is inflation, measured primarily through the Consumer Price Index (CPI). Inflation has taken center stage recently, with many global economies, including the US, UK, and Europe, battling historically high levels. Higher inflation typically pushes central banks towards tighter monetary policies. Think rising interest rates, which can strengthen currencies but dampen stock market performance. Lower inflation or deflation, conversely, signals economic weakness and can trigger central banks to reduce rates, hoping to stimulate growth. For forex traders especially, inflation data releases have become high volatility events in today's markets. Interest rates, closely tied to inflation, are our third crucial indicator. Central banks, such as the Federal Reserve, European Central Bank, and Bank of England, adjust interest rates to control economic growth and inflation. The aggressive rate hikes by the Fed over the past year have caused significant currency fluctuations and reshaped global investment flows, illustrating how critical this indicator is. Higher interest rates attract foreign investments due to increased returns, strengthening the local currency, but potentially pressuring stock markets due to higher borrowing costs. Employment data, specifically non-farm payrolls, NFP, from the US, is another market-moving indicator. Recently, NFP reports have consistently shown resilience despite interest rate hikes, complicating the Fed's policy decisions. Strong employment figures generally signal economic expansion, boosting stocks and the dollar. Conversely, weak employment data, especially if sustained, points to economic contraction, negatively impacting markets. Stagflation, high inflation combined with stagnant growth and rising unemployment, has become a real concern, and traders must watch employment data closely for signs of this troubling scenario. Retail sales are another key indicator, reflecting consumer spending and economic confidence. Robust retail sales figures often fuel bullish sentiment in markets, as consumer spending drives a significant portion of GDP. Recent fluctuations in retail sales, impacted by inflation and consumer sentiment shifts, have caused notable volatility in stocks and forex markets. Retail traders should compare retail sales data against GDP and consumer confidence for more comprehensive insights. The trade balance, measuring the difference between exports and imports, significantly influences currency valuations. Countries running a trade surplus typically see their currencies appreciate due to increased foreign demand. In contrast, trade deficits can lead to currency depreciation. Recent trade tensions, particularly between major economies like the US and China, continue to drive volatility in forex markets, emphasizing the importance of closely monitoring trade data. Consumer Confidence Index (CCI) measures consumer sentiment towards the economy and future spending. High confidence levels suggest strong upcoming spending, supporting economic growth and stock market rallies. Recent sharp swings in consumer confidence, driven by inflation concerns and geopolitical tensions, have made this indicator particularly impactful. The housing market is another pivotal economic indicator. Home sales and price data provide clear signals of economic strength or weakness. The recent cooling of global housing markets, influenced by rising mortgage rates, is a critical warning sign for traders and investors alike, highlighting the housing sector's role as a leading economic barometer. Beyond these primary indicators, traders should also track manufacturing and industrial production data. The Purchasing Managers Index, PMI, which reflects manufacturing sector health, offers early signals of economic expansion or contraction. Recently, global PMI readings have fluctuated due to supply chain disruptions and shifts in demand, notably in manufacturing-heavy economies. Lastly, traders must consider government fiscal policy and national debt levels. Fiscal policies like tax cuts, government spending programs, and debt management significantly impact economic stability. Recent budget announcements, notably from major economies coping with rising debt levels post-pandemic, illustrate how fiscal measures can influence market sentiment and currency stability. Now, how can retail traders effectively use these indicators? Firstly, stay informed with an economic calendar, keeping track of when critical data is released. Platforms like Crystal Ball Markets offer detailed economic calendars that allow you to prepare for potential volatility ahead. Secondly, analyze historical market reactions to these indicators. Understand how specific assets typically respond to different economic releases, allowing you to identify trading patterns and opportunities. Thirdly, combine fundamental analysis from economic indicators with technical analysis from chart patterns and trends. This blended approach significantly enhances your trading accuracy. Lastly, always manage your risk. Economic data releases often create market volatility, so incorporating strategies such as stop-loss orders and appropriate position sizing will protect your trading capital. To wrap up today's discussion, understanding and effectively utilizing economic indicators is essential for trading success. By closely monitoring GDP, inflation rates, interest rates, employment data, retail sales, trade balances, consumer confidence, housing data, manufacturing trends, and fiscal policies, traders can anticipate market moves and trade confidently. For more insights and tools, platforms like crystalballmarkets.com remain invaluable resources to elevate your trading strategy. That's it for today's episode on economic indicators. I'm Sophia, and thanks for tuning in to Financial Market Insights for Traders. Stay informed, trade wisely, and I'll catch you in our next episode.